Good morning, everyone. Thank you for attending the World Economic Outlook press conference this morning. I'd like to introduce Maurice Obstfeld, Economic Counselor and Director of the Research Department, and Gian Maria Milesi Ferretti, Deputy Director of the Research Department, and he oversees the production of the World Economic Outlook. Maury will give press remarks, and then we will take questions. I'd like to tell you that there is translation that is available. Channel 1 is English, Channel 2 Bahasa, Channel 3 Spanish, Channel 4 Arabic, Channel 5 French, Channel 6 Chinese, and Channel 7 Portuguese. Maury, over to you, please.
Okay, thank you very much, Wafa. Good morning, everyone. I'd like to say, first of all, a very big thank you to the government of Indonesia, the people of Indonesia, whose collaboration in putting together this set of annual meetings has been remarkable. We're here to very much highlight the dynamism of Indonesia, of the entire Asian region, which in fact now accounts for over 60% of global growth. Let me secondly extend our condolences to the survivors, families, friends of the very tragic events in Lombok and Sulawesi. Our hearts go out to you, and we very much share your grief at these events. Okay, the latest World Economic Outlook report projects that global growth will remain steady over this year and next at last year's rate of 3.7%. This growth exceeds that achieved in any of the years between 2012 and 2016, and it occurs as many economies have reached or are nearing full employment and as earlier deflationary fears have dissipated. Thus, policymakers still have an excellent opportunity to build resilience and implement growth-enhancing reforms. Last April, at the time of our last World Economic Outlook, the world economy's broad-based momentum led us to project a 3.9% growth rate for both this year and next. Considering developments since then, however, that number now appears over-optimistic. Rather than rising, growth has plateaued at 3.7%. And there are clouds on the horizon. Growth has proven to be less balanced than we had hoped. Not only have some downside risks that the last WEO identified been realized, the likelihood of further negative shocks to our growth forecast has risen. In several key economies, moreover, growth is being supported by policies that seem unsustainable over the longer term. These concerns raise the urgency for policymakers to act. Growth in the United States, buoyed by a pro-cyclical fiscal package, continues at a robust pace and is driving U.S. interest rates higher. But U.S. growth will decline once parts of its fiscal stimulus go into reverse. Notwithstanding the present demand momentum in the U.S., we have downgraded its 2019 growth forecast owing to the recently enacted tariffs on a wide range of imports from China and China's retaliation. China's expected 2019 growth is also marked down. Domestic Chinese policies are likely to prevent an even larger growth decline than the one we project, but at the cost of prolonging internal financial imbalances. Overall, compared with 6 months ago, projected 2018-2019 growth in advanced economies is 0.1 percentage point lower, including downgrades for the Euro area, the United Kingdom, and Korea. The negative revisions for emerging market and developing economies are more severe, at minus 0.2 and minus 0.4 percentage point respectively for this year and next year. These revisions are also geographically diverse, encompassing important economies in Latin America, notably Argentina, Brazil, and Mexico, in emerging Europe, notably Turkey, in South Asia, notably India, in East Asia, notably Indonesia, Malaysia, also the Philippines, in the Middle East, Iran, and Africa, South Africa. Although some petroleum exporters, including Nigeria, Kazakhstan, Russia, and Saudi Arabia, are going to benefit from higher prices. Broadly speaking, though, we see signs of lower investment and manufacturing coupled with weaker trade growth. With their core inflation rates largely quiescent, advanced economies continue to enjoy easy financial conditions. But this is not true in emerging and developing economies where financial conditions have tightened markedly over the past 6 months, as the new Global Financial Stability Report will explain in detail. You'll have that briefing tomorrow. The chart that accompanies the blog version of this shows that there has been a preponderance of interest rate increases. For emerging and developing economies, gradually tightening US monetary policy, coupled with trade uncertainties, and for countries such as Argentina, Brazil, South Africa, and Turkey, distinctive factors have discouraged capital inflows, weakened currencies, depressed equity markets, and pressured interest rates and spreads. The high levels of corporate and sovereign debt built up over years of easy global financial conditions, which the latest fiscal monitor will document, constitute a potential fault line. And you'll hear more about that as well tomorrow. Now, importantly, I want to stress this, we do not see recent developments as part of a generalized investor pullback from emerging and frontier markets, nor do we expect the current problem cases necessarily to spill over to countries with stronger fundamentals. Many emerging economies are managing relatively well, given the common tightening they face, using established monetary frameworks based on exchange rate flexibility. But there's no denying that the susceptibility to large global shocks has risen. Any sharp reversal for emerging markets would pose a significant threat to advanced economies, as emerging market and developing economies' GDP now constitutes about 40% of world GDP at market exchange rates. Other downside risks that now appear more prominent for the near term relate to further disruptions in trade policies. Two major regional trade arrangements are in flux. The US-Mexico-Canada agreement still awaits legislative approval, and the European Union, where the exit terms of Brexit of Britain, of the UK, are being negotiated. US tariffs on China and more broadly on auto and auto part imports may disrupt established supply chains, especially if met by retaliation. And we have some simulations on this in the New World Economic Outlook. Reflecting these developments, news-based indicators of policy uncertainty have spiked recently, even if advanced country asset markets remain less concerned. The impacts of trade policy and uncertainty are becoming evident at the macroeconomic level, while anecdotal evidence accumulates on the resulting harm to companies. Trade policy reflects politics, and politics remain unsettled in several countries, posing further risks. To gauge the severity of the threats to growth, one must ask how governments could respond if risks are realized and widespread recession ensues. The answer is not comforting. Mechanisms of multilateral global policy cooperation are under strain, notably in trade, and need strengthening. Governments have less fiscal and monetary ammunition than when the global financial crisis broke out 10 years ago, and they therefore need to build their fiscal buffers and enhance resilience in other ways, including by upgrading financial regulatory regimes and enacting structural reforms that raise business and labor market dynamism. Despite the possibility of less political space in some countries, making consensus on sound policies often harder to reach, There will not be a better time than now for positive action. Given the uncertainties of the moment, it is too easy to lose sight of the longer-term forces and challenges that have brought us to the current economic and political crossroads and will shape the longer-term future. Perhaps the biggest secular challenge for many advanced economies centers on the slow growth of workers' incomes, perceptions of lower social mobility, and in some countries, inadequate policy responses to structural economic change. Emerging market and developing economies are diverse and face an array of longer-term challenges ranging from improving investment environments to reducing labor market duality to upgrading educational systems. The dangers of climate change loom in the background but are rapidly intensifying. Regardless of income level, all countries must prepare their workforces for the ways that new technologies will change the nature of work. Ensuring that growth is inclusive is more important than ever. And unless growth can be made more inclusive than it has been, centrist and multilateral approaches to politics and policy will become increasingly vulnerable to the detriment of all. And with that, we'll welcome your questions.
Thank you, Maury. We will now take your questions. Please identify yourself and the media organization you work for. Yes, please. The lady on the second row.
East Media Group, and you have mentioned several risks related to the world economy, such as trade policies and emerging markets. And could you predict that how big the impact can be on the global economy and also on China's economy? And could you give us the worst case scenario? Thank you.
Well, we've run some scenarios in the World Economic Outlook, and you know, I'm not sure that we incorporate absolutely the worst case. We try to look at the kind of actions that have been talked about and retaliation against those actions. And we also try to incorporate what we think are fairly realistic effects on policy uncertainty, which can hurt investment, and on confidence, which affect asset markets. But it's definitely possible in those scenarios to take close to a percentage point off of world GDP growth if all countries act and retaliate. Now, in terms of China, our forecast for next year, for 2019 growth, has been downgraded due to the tariffs that we have actually seen on the the 200 billion of imports into the U.S. And that is an impact on China of 0.7% of GDP relative to our baseline forecast. We assume, however, that 0.5 percentage point of that is offset by the Chinese authorities' stabilization of the domestic economy, leading to a net fall of 0.2%. That set of actions, by the way, also reduces our forecast of U.S. growth for next year because we factor in China's retaliation.
Yes, please, the first row.
Ricardo Leopoldo, Agência Estado, Brazil. To Mr. Obstfeld, the World Economic Outlook emphasizes 2 points, especially about Brazil. One is about the need for social reforms, especially the social security, and also the stance of monetary policy in Brazil is supposed to be accommodative, especially because we have high unemployment and the growth is not so strong. So, what do you expect for the new administration in Brazil, no matter who is going to be the president, to achieve those two policies? Thank you.
Yeah. Jean-Marie, do you want to take on that one?
So, yes, indeed, the key policy issue facing Brazil is high public debt and a high burden of pension spending, early retirement. And in order to stabilize the debt to GDP ratio, Social Security reform is clearly necessary, and that will have to be a policy priority of the next administration. Brazil's monetary policy framework is a strong one, and that has allowed a monetary policy conduct that has been counter-cyclical, so easing monetary policy to help a recovery that is still very weak. But going forward, it is really essential to show policy progress on the fiscal stabilization front, also because the international environment, it has become more difficult. External financing, external financial conditions have become tighter. And clearly, in a situation where markets discriminate more depending on countries' vulnerabilities, these priorities become all the more urgent.
Thank you. David.
Hi, Maury. David Lauder with Reuters from Washington. You seem to be suggesting in this report that, at least in the current circumstances, this is about as good as it gets, that if things continue on the same path, that we're headed for slower growth. I'm wondering if the U.S. and China are able to resolve their trade differences, if the U.S. does not impose the car tariffs on Europe and Japan, they are able to come to some agreement there. You've seen the agreement in NAFTA where Mexico and Canada would be spared from most of the, even if they do impose those car tariffs. Are we, if these trade tensions do go away, are we likely to see stronger growth going ahead, or is the cycle old enough where it's still going to be facing headwinds and we're going to see slower growth? Thanks.
Yeah, thank you for that, David. You know, the possibility that China and the U.S. Resolve their disagreements would be a significant upside to the forecast. You know, at some level, I think it's not surprising that we are more tentative in our optimism than we were 6 months ago, because, you know, if you have the world's two largest economies at odds, that's a situation in which everyone is going to suffer. So, you know, it would be great if talks could lead to an accommodation in which disruptions to trade were, you know, put aside. But, you know, where we are now is kind of a, you know, what we've characterized as a plateau. Back 6 months ago, we saw a very balanced expansion. We saw a lot of upgrades in a lot of countries, a lot of momentum with risks evenly balanced upside and downside. And now growth is much more uneven. And you know, I should stress that you know, even if you look across the emerging market landscape and the frontier market landscape, you know, it is not the case that there are downgrades everywhere or that all countries are doing badly. In some cases where we have downgrades, countries are still growing at fairly healthy rates. You look at a region like Latin America, I mentioned the large economies, Argentina, Brazil, Mexico, which naturally attract a lot of attention, but we have upgrades in the forecast for Chile, Colombia, Peru, Bolivia. You know, you look at Africa, there are upgrades for Kenya and Uganda, although again, South Africa is a downgrade. So it's a very mixed picture, but you know, when you do have this sort of uneven growth and countries are not all pulling in the same direction, you do see less momentum than we, you know, were so excited about 6 months ago. Where things will go from here on in, you know, we don't know.
Excellent. Gentleman in the second row. Yeah, there's
Buenos días, en Spanish. Buenos días.
Very good morning. Antonio Vargas, Noticia Antiqueño from Medellin, Colombia. I'm very pleased to be here in this paradise, this exotic location after a 27-hour flight with a couple of stops. You have referred to a possible recession and the risks that some countries' economies are facing. What would you say about the possibility that some of the world's economies have not learned from the crises that have occurred in the past? Thank you.
Well, we have a chapter in the World Economic Outlook that is being released today on the legacy of the global financial crisis, and you know, I would say that there have been important lessons learned from that event. You know, in many countries, banks are better capitalized and are safer. The Basel III framework was developed and is being put into place. Countries continue to rely on policy frameworks that, in many cases, actually serve them quite well in the global crisis itself. You know, where our concerns are in the fact that, you know, partially as a legacy of the crisis and the financial disruption and the recession that it caused, many countries have higher public debts than they had before. Interest rates are still quite low in many countries, leaving less room to cut should a new recession ensue. And even though there's been a lot of progress on financial stability, and you'll hear more about that tomorrow at the Global Financial Stability Report press conference, there's still work to be done on the agenda, you know, importantly in the area of non-banks and in other areas. So, you know, this is why we recommend to countries to continue implementing structural reforms. This would increase growth. This would raise natural real rates of interest throughout the world, to rebuild fiscal buffers so that they have the ammunition to respond if there is a crisis. And I think one of the lessons of the last crisis was that fiscal policy can be very powerful in combating recession. And so if you're in a situation where public debts are already too high, where markets might react adversely to a further increase in public debt, that could limit the positive effects of your fiscal actions. So, you know, to summarize, countries have learned a lot, but there's certainly more work to be done to prepare for the next recession.
the lady in the second row.
Thank you very much. My name is Yolanda Morales. I'm from Mexico in El Economista. Now that the uncertainty in the NAFTA and the presidential elections in Mexico have finished, you still quote your prospects for Mexico. I want to know what is the issue that is slowing our increase in the economy. And if you please tell me which is the main challenge that you see for the new Mexican government in Mexico. Thank you.
Sure. So the growth prospects for Mexico have been marked down slightly compared to our forecast in April. The we forecast 2.2% growth for this year, 2.5 growth for next year. I think there are two main factors at play to explain the downward revisions. The first one is that data, particularly for the second quarter of this year, was quite weak. So that is naturally going to affect the level of growth for this year. And there is still persistent uncertainty concerning trade, even though clearly the agreement that has been reached, if ratified, can help lift that uncertainty. But we also have some downward revision for next year, or US growth, which is of course very meaningful for the Mexican economy. You asked about the challenges for the new administration. I would say two things. On the more traditional economic policy front, I think building on the strength of the policy framework, a strong independent central bank, and a robust fiscal policy framework can still be improved, but still is a robust fiscal policy framework. Important to build on the strength of these institutions. I think we have a chapter in the WEO that documents how important the strength of those institutions is for the credibility of monetary policy, for anchoring inflation expectations. Say the second set of challenges relates to the structural conditions to continuing the fight against corruption, reducing crime, because those are clearly factors that are affecting confidence, that are affecting the level of investment, even though, again, the macro policy management has been very strong. And it's also very important to build on the successes in the reforms that have already been implemented, because they give potential for higher growth in the future for the Mexican economy.
Good morning, Helmer Price from Alliance News. Maurice, in terms of your cutoff time, when was that for the World Economic Outlook? And if you could then comment if subsequent to that, the Economic Stimulus Plan and Job Summit in South Africa, the latest developments in terms of Italy with the fiscal deficit, and then also in terms of Brexit, is it more likely to get a no deal, or what's your, in terms of latest developments?
So I didn't hear the very first part of the question.
In the cutoff time for the World Economic...
Sorry?
The cutoff time?
The
cutoff time.
Oh.
Yeah. So when do you finalize the World Economic Outlook? Because I think the ones that I've mentioned are subsequent, maybe, to that, and whether that makes an impact.
Okay, and then there was the South African Job Summit.
And stimulus plan, and then in terms of Italy, what's happened in terms of the fiscal deficit, which I presume is also subsequent to that, and then also just in terms of Brexit negotiations.
Yeah, so when was our cutoff date? Remember when we got our last submissions?
De facto, we finalized right after the tariffs were imposed on China, so those are incorporated. Must have been the 17th, just after mid-September. So that's
okay. Yeah, on the South African Job Summit and stimulus plan, I will punt that to the African regional briefing at the end of the week, because they're following developments more closely than we are. The issues of Italy and Brexit are, of more systemic significance. Our concern about Italy is that there's a real imperative for the fiscal policy to maintain confidence, the confidence of markets, and we have seen spreads increase over the past months. This has certainly contributed to our downgrade of Italian growth, and makes the economy more susceptible to shocks. So we think it's important that the government operate within the framework of the European rules, which are also important for the stability of the of the Eurozone itself. On Brexit, our baseline forecast, which underlies our forecast for the UK and for the Eurozone, is that a deal will be reached. It will be one in which trade in goods is essentially tariff-free, which would allow most supply chains to remain intact. It is one in which the regime for financial services would be quite favorable to the UK. And I recognize that that's an optimistic scenario, but we tend to assume that when some set of economic arrangements is clearly in the joint interests of the negotiators, that somehow they will manage to make this come about. Obviously, if this does not come about, if there are arrangements which are more restrictive of trade, which put up more barriers, which disrupt supply chains, then this is going to be more challenging for both the UK and its Eurozone partners. And there are some very critical areas where technical agreement does have to be reached. For example, on how to handle clearing of derivatives over the the transition from old arrangements to new arrangements. So we know the negotiators have been working very hard. In fact, there's been a remarkable amount of progress on a lot of issues, and this often goes unnoted. But there are some very key elements that have not been resolved and that seem very difficult. So until we get more information, we will keep with our assumption that reason will and good policy will prevail, and hopefully will be proven right.
Third row, second gentleman.
Hi, Maury. Andrew Mayada with Bloomberg News. Well, you definitely picked a nice place for your farewell annual meetings, so thank you for that. And thank you for your service. You've always been very gracious with the media, and that's not something we can take for given these days, so thank you for that. My question is about monetary policy. We saw People's Bank of China ease monetary policy, I think, yesterday. We seem to be seeing this divergence where the Fed is tightening faster than other central banks. Just wondering if you can talk about how you see that rippling through the global economy.
Yeah. Thank you for those kind words, Andrew. It's been a pleasure to work with you over these several years as well. So, on the Fed, we have actually been seeing this story for a long time. Starting perhaps with the taper tantrum, but also the dollar's strong appreciation starting in the summer of 2014. So it's not like news that the U.S. has been recovering from the aftermath of the global financial crisis more quickly than other advanced economies. What's been added into the mix, perhaps, is that the pace of recovery in the U.S. has been boosted. I wouldn't even call it recovery. The U.S. has recovered. Pace of expansion has been boosted by a pro-cyclical fiscal policy, which is, arguably leading the Fed to raise interest rates more quickly than it otherwise would. We, like, the Fed dot plots, are forecasting one more hike this year in December, which will bring the total number to 4 for this year. And this naturally leads to some dollar strength. It leads to increases in interest burdens for indebted sovereigns and corporates. So it does carry some risks, which is why the general strength of the policy framework is so important. Many emerging economies have been navigating this quite well for some time. It's also true over this period that there have been periodic concerns about China's growth. When I came to the fund in September of 2015, this was shortly after the RMB devaluation and the switch in China's exchange rate regime. We had a period of several months of concerns, and so this has also been a theme, and so we shouldn't place too much weight, I think, on these short-term developments. China's growth in the first half of this year was very strong. There have certainly been indicators of less robust growth more recently, but remember that in line with our advice and in line with what the Chinese authorities also have strongly endorsed, there have been attempts to tighten up the financial sector, particularly the non-bank sector, and to reduce the pace of credit growth, which everyone agrees is too high and has been a potential risk. And it was completely predictable that this would somewhat slow Chinese growth. Now, on top of that, growth in China has arguably been affected by trade tensions with the United States. So, what we have recommended, what our sort of mantra has been for a while, is that the Chinese authorities should de-emphasize the quantity of growth and think more about the quality of growth, i.e. the sustainability of growth longer term and its resilience to financial instability events. And our advice to China is to sort of stay the course. I mean, they are naturally taking some steps on the monetary front, like the action you mentioned, to shore up the economy. But they do have to balance those actions against the need to achieve a more stable financial sector, to achieve more deleveraging than they have, to exert better control over local government financing. And it is definitely going to be a balancing act for them going forward. But again, markets often tend to put tremendous weight on the most recent developments and perhaps exaggerate them. And much of what we're seeing now, we've seen at various times in various forms over the last couple of years. So it's not totally new.
Thank you. The gentleman in the fifth row, please.
Thank you very much, all of you. Thank you for your information about World Economic. My question, I'm from Somalia, East Africa. My question is, how about expectation of economic growth development in 2019 and 2020 in Africa compared with developing countries? And what are the suggestions that you have or recommendations to them?
So I didn't quite hear the first part of that. Okay. As I indicated, Africa is incredibly diverse, and so it is hard to summarize, and it's easy to oversimplify. There are a number of economies that are doing quite well. There are countries like South Sudan, which have quite negative growth rates, suffering civil strife, and this creates a very varied picture. Overall, we are projecting, and John Maria can correct me, that African growth is rising. It's rising in the nearer term to somewhere around 4%. And that, unfortunately, is a rate of growth that is really not sufficient to meet sustainable development goals, to fully employ a rapidly growing workforce. So, just broadly speaking, while different economies face different challenges, there is a real need for very thoroughgoing and ambitious structural reforms in Africa that would raise efficiency, bring people, particularly young people, into the labor force. In many countries where debt is high, put it on a more sustainable course, and in many countries also to improve governance, which is a very big problem in a number of countries. I don't know if you want to add to that, Gian Maria.
Maybe just to add that the aggregate growth rate for the continent is held down by the fact that the three largest economies are not performing up to their potential. Nigeria's growth, 1.9% this year, 2.3% next year. South Africa only 0.8% this year. Angola contracting by 0.1% this year. So the aggregate is over 3% this year, close to 4% next year, is despite the largest economies in the continent doing poorly. The continent could do much better once these economies are on a more solid footing, particularly South Africa and Nigeria, because they're really large and affect a number of countries in their neighborhood.
Thank you. The gentleman on the sixth row.
Hi, thank you. I'm Bagus. I'm from the Indonesian media. I've been wondering, because this is Indonesia and we are hosting the meeting here, and I think it is important for us to also understand what the World Bank or IMF think about Indonesian economy, because you already mentioned about Indonesia as one of the emerging economy today. However, we see that there's a lot of heated discussion on how the dollar have increased against Indonesian rupiah. And also emphasizing on Indonesia will face the general election, major election next year. So how do you think that Indonesian policy should do in order to stabilize their economy? And also, what do you think about how Indonesia economy could thrive today in today's economy because of a lot of recessions going on also? Thank you.
Yeah. Well, I think it's important to realize, number one, that the gradual tightening of monetary policy in the U.S., the approach of more tightening in the euro area, and the general tightening of financial conditions facing emerging markets throughout the world is a common factor that a number of countries are contending with. And it's easy from the perspective of one's own country to talk about the weakness of the currency, but if you take a broader view of the world, you might talk more naturally about the strength of the dollar, and I think that's what we're seeing. One way to gauge this is to note that even though the rupiah this year has depreciated against the dollar by something like 10%, its depreciation on a weighted effective basis against its trade partners is only 4%. So one doesn't want to exaggerate the extent of the issue. So that's important to keep in mind. The Indonesian growth story has been a real success story, and even though we have downgraded our growth forecast for the next couple of years due to a number of factors, tighter global financial conditions, oil prices, the effect of US-China trade tensions and how those might affect Indonesia. Growth is still expected to be fairly strong. And this provides an opportunity for the government to bring up the level of what it does for the Indonesian people to something more consistent with the growing incomes that the population enjoys. For countries of Indonesia's income level, we would think that there might be a higher level of tax revenue, which would allow investments in the educational system, in infrastructure, in the social safety net, all of which would be very beneficial, I think, to the people. So our sort of advice really to all countries of Indonesia's income status are to look at those issues, to try to raise the agility of the workforce, to raise the human capital of the workforce, to fight further against inequality, which has come down in Indonesia in recent years.
The gentleman in the third row, please. Chris, you will ask. You're after, and then the lady in the back.
Chris Giles from the Financial Times. Pakistan's government has announced that this week it will seek emergency bailout from the fund. Can you talk about the challenges facing its economy and its ability to finance itself?
Yeah, as far as I know, we have read the news stories too. We have not been formally approached yet, and as with any member in good standing, they are certainly entitled to request financial support from the fund. So we will be listening very, very attentively when and if they come to us. Pakistan is suffering from a number of imbalances, a very large fiscal imbalance, a large current account imbalance. They also have a low level of reserves and a currency that is too rigid and overvalued. And as a result, they are having financing gaps. So I assume that is what they will want to talk to us about. Their government has expressed a desire to enact deep structural reforms that might break the cycle of Pakistan needing financial support from the fund. Frequently, they have had programs in the past several times, and that is a very good sign going forward. So again, there may, when Mr. Azur gives the briefing for his region toward the end of the week, he may have more for you on that, but that's all I have now.
Yes, the regional economic outlook press conferences will be held on Friday, and the Africa Regional Economic Outlook will be held on Thursday. The gentleman in the second row, please. Can you identify yourselves and the organization that you work for?
Thank you very much. My name is Hassan, Hassan. I'm happy that the question which was put just before me referred to Pakistan. My question was actually a part of the question that he had raised. First of all, I'm 82 years old, maybe possibly the oldest person in the gathering today. I have been attending the IMF World Economic Outlook gathering for the last many years, and I have met all the past previous MDs of the IMF. I have two questions to ask. First of all, there has been a lot of transition, changes in the entire financial world all over the globe. IMF's policy that stands today, which was a few years before, do you think with the change in the financial situation all over the world, IMF will go through some change in its policy in future, in a near future? That's the one question. The second question is, Pakistan today has a new government. And as you said, we are facing a lot of challenges. Of all the challenges, if I take as number one, Pakistan is at the moment in the gray list. And there is a fear that it might be turned into black. But there is a lot of effort that we get out of this problem. How do you view the optimism that comes from Pakistan to get out from the gray and get back to the original position? The second is, you spoke about China. China and Pakistan are two very close friends. I would like your opinion on the China-Pakistan economic corridor.
Thank you.
And there has been a lot of work going on in terms of progress of Pakistan's coastal areas, roads, and other things. How does IMF view the relationship and the development progress that is coming from China to Pakistan?
Thank you.
Thank you very much.
Okay, thank you for those questions, Hassan, and may you attend many more annual meetings. I won't be here, but hopefully you will. You know, on the financial system, you know, finance is very dynamic and has evolved and continues to evolve. And you know, one of the important evolutions of the IMF over the years has been its much greater attention to the details of financial markets. Back in 1980 or so, there was no financial stability report, and in fact, the fund began a capital markets report within the confines of my department, the research department, and that proved so influential that it ultimately became the flagship of our current MCM, Money and Capital Markets Department, which, you know, didn't exist back in 1980. It just wasn't thought of as being part of the sort of main sort of macro framework that the fund worried about. So, you know, if you come to the briefing that my colleague, Mr. Adrian, will give tomorrow with his staff, you will see the you know, the results of that in its full glory. And you know, I think one of the lessons we've learned, and this goes to the lessons of the crisis, is you know, you have to watch financial markets very carefully because they change, they evolve, particularly when you put constraints on them, regulatory constraints. They evolve in such a way as to evade them. And so a lot of the work that we do through our financial sector assessments, through our analysis, is to try to track this and not to be always in a situation where we're fighting the last war. So that is a real challenge going forward that we take very seriously. You know, in Pakistan, you know, this is obviously a country with immense potential. And again, you know, our job at the fund, through our surveillance, through our capacity development, is to help our members try to attain their potential. You know, if we enter into discussions later this week on a possible program, that will be another opportunity to try to make progress. And again, as I said, the government seems to have the idea, which is a good idea, of making durable progress And so if that can happen, that would be terrific for Pakistan and its people. On cooperation with China, this has definite potential benefits, but also risks. Pakistan needs more infrastructure, as you said, and this is a source of infrastructure and connectivity. But it's also important that the design of projects, the governance of projects, be sound, and that excessive debts which cannot be repaid are avoided, because that just leads to financial instability and to lower growth.
Thank you. We have one more question. The lady in the back, please. Yes.
Thank you for the opportunity. My name is Nadia Atmaji from Metro TV. You said that some countries, especially the emerging countries, are responding in different way towards the economic situation. In the case of Indonesia, amidst this uncertainty, we're still trying to boost our and to maintain our infrastructure development, and now we are looking for a new financing scheme. And what do you think about this strategy to respond to the situation of the economy?
Well, Indonesia definitely needs more and better infrastructure along a number of dimensions, and so the efforts that the government has made are very welcome. We also think that Indonesia could benefit even more from further opening to foreign direct investment, which could supply a greater degree of its infrastructure needs. Indonesia is a rapidly growing economy. It is a huge market. Foreign direct investors will find it very attractive in a setting where they are facing fewer regulations or fewer restrictions. So I think for Indonesia, this is possibly a very attractive way forward.
Thank you very much, Maury. This is your last press conference, World Economic Outlook press conference. Is there anything you would like to say to the media?
Yes, thank you, Wafa. I'm going to return Andrew's compliment now. One of the most satisfying and I think important functions of the job of the economic counselor of the IMF is to give these press conferences and to interact with the press. This is obviously important to you. It's your job, but also I think it's important to the effectiveness of the fund. And so we put a lot of effort, a tremendous amount of effort, into preparing for these press conferences and to thinking about how we can best respond to your questions. You in the press and we are actually partners in educating people about the economic issues that are very central to their lives. Your demand for clear communication from us helps us to bring our message closer to those who we seek to help, which are the populations of our 189 member countries. Your questions, particularly when they are hard questions, also help to raise our credibility in the long run, no matter how uncomfortable they might make us in the short run, because they keep us accountable, and the public sees that we are accountable. So, I want to say thank you to you for all that you do. You help us to present an alternative vision to those who deride experts and expertise, and that's very important in today's world.
Thank you. Thank you again, and thank you, Jean-Maria. Thank you for attending the press conference. Thank you very much.
¿cómo está? Ha venido hasta aquí. Qué sitio lindo, ¿verdad?